Hey everybody, Courtney Smith here with our new edition of Wall Street Winners for March the 7th, 2022. And of course, this is our disclaimer for March 7th, 2022 as well. So it looks as though the S&P is starting to move to a new leg on the downside. Take a look at this chart right here. You can see that on Thursday, we made a higher move on this little mini up move, and then on Friday we kind of gave it all back. Now the good news was we ended towards the high of the day, which is a sign of bullishness, but look at the purple predictor. The purple predictor is just collapsing, and when the price made a new high, the purple predictor did not, showing that the smart money is selling. We like to follow the smart money. Over here in the Dow, in the upper right-hand corner, you can see that the selling pressure had abated. As I told you it did a week ago, it would come down because it's unsustainable at the levels that we saw 2 weeks ago. But then on Friday, it hooked up a little bit. But notice the little green line. No increase in buying pressure last week at all. No increase in buying pressure at all. So selling pressure came down, but buying pressure did not go up. That's not a sign of a sustainable bull market, as I told you. The NASDAQ, a similar situation, another leg down here. Purple predictor also a bit negative. Now, seasonality, normally seasonality is bullish at this time of year, and we'll get to the seasonal chart in just a second. But it's really gone nowhere. This has been a terrible year for seasonality. The directions have been perfect. But the IWM, we've never gotten a buy signal for months. But look at utilities have taken off to the upside in a flight to quality. Now they start turning bullish May 1st. But I always like to start a month early. So starting in April, we'll actually start to look for a switch to looks like we might get a bullish utility signal. So keep an eye out on that one. That looks like our next big seasonal. Now, according to Stock Traders Almanac, we should be in a bull move right now. And it should last until really towards the end of April. It doesn't matter what scenario you pick, that's what's supposed to happen. But so far, yes, we did get the beginning parts of that little bull move, but Friday's price action was not good. So we have to kind of take this into consideration and say, well, maybe Friday was the anomaly, and that we're going to start to head back up again. If we break above Thursday's high, yes, we're back into the bull scenario based on the bullish seasonality. If we do not break Thursday's high, we will continue to press this on the short side. So we're at a very important turning point here in the market. Asset allocation, pretty stable the last couple of weeks, but the stock market risk indicator took another dive down. So what does that say? It says that there's a huge rotation inside of the stock market and that people are continuing to move from risky stocks, technology stocks, and they're moving into utilities. You saw that utility stock chart. That thing was skyrocketing. It's like somebody lit a fire under it, okay? So they're moving into energy. They're moving into utilities. They're moving into real estate. So they're staying in the stock market. They're not getting out of the stock market, but they're rotating inside the stock market and moving into those other low-risk sectors, which means we need to be buying those sectors. Global shares hit a new low this is probably new one-year low. If you look very closely on the far right-hand side, there's a bar way down there, a huge gap on Friday. This is mainly dominated by European shares, and they do not like the Ukrainian situation. Another big move here. Yield curve. I said last week, well, these long-term interest rates look like they're going to go down. Or I said it to the fully paid up members, sorry. But look at this. So the yield curve is flattening dramatically. And it's flattening because the long end of the yield curve, the yields are going lower. And of course, the short end of the yield curve, they're going up a little bit. Now look in the lower left-hand corner, and you can see that from really 2 years out, the yield curve is almost flat. It's only the very short period from 0 to 2 years where there's any positivity in the market at all. I mean, other than minor amounts. And that's because the Fed hasn't raised interest rates yet. So as soon as the Fed raises interest rates by 25 or 50 basis points, all of a sudden the left side of that curve is going to not look as positive. It's going to look flatter, just like the rest of the curve. My point is simply this. We are not getting a recession signal or bear market signal from the yield curve, but we're getting darn close. We're getting darn close. Now, I follow the rules, so I'm not going to say it's a bear market and a recession, but man, I'm giving you an early warning here saying, look at that yield curve. Once the Fed start raising interest rates, we're going to see this thing get flat in 3 to 6 months, which means that in 2023, it's recession time. Okay, bonds moving up sharply, and look at the purple predictor is taking off. The smart money is buying bonds like crazy. Once again, this rotation into safety. Safety is what everybody is running towards. Bond key factors. Whoa, this is an amazing chart. So the green line is Treasury note yields in the U.S., and you can see they came down sharply. The blue line are Treasury yields in Germany. And you can see that basically people said, we don't want any European stocks, give us German bonds. And so the yields collapsed dramatically. Now the chart behind there and gold both took off to the upside, showing increasing inflationary pressures, which will cause bonds to rally. Bond yields to go up, bonds to go down, but not yet, The dollar explodes as a flight to quality. The Ukrainian situation, once again, everybody's flooding into dollars because what? You want euros? You want yuan? Oh no, you probably want rubles. Well, they've dropped 99% in value in the last month, so they're cheap now. Gold. Really a nice bull market. Finally, we've had a nice breakout, and Friday was a good day in the gold market. I'm getting more and more bullish. We have a light gold position in our portfolio, obviously helping out our equity statement. But gold is up hard. Our gold key indicators, you can see the top one is bearish, the middle one is bullish, and the bottom one is neutral, but fully paid up members. This, by the way, if you're a freebie, this is why you need to be a fully paid up member, because there we give my best indicator for calling the gold market. I'll let you know, it's bullish. Crude oil has accelerated after breaking out of the trading range that we had in late February. And you can see we've closed at the highest price since 2008. And, okay, I give up. It's a bull market. You got to be long. Now, we're long some really good energy stocks right now, so that's helping out the portfolio quite a bit as well. But this is going higher. I mean, this says 115. That means Brent is over 120. Remember the previous peak was 140, 145 back in 2008. You probably remember that pretty clearly. And I think that's the target the market is looking for right now. Bitcoin is just following the stock market, only more bearishly. No, it's really basically just become a clone of the stock market at this point, so I can't get exciting trading it at all. One of the most important things is when you get into a crisis situation, and I think we are in a crisis situation, you always just want to trade the primary market. Bitcoin's not the primary market. The stock market, to a certain extent, is the primary market, but really the primary market right now is energy. That's really where every focus should be. Okay, freebies, love having you here. Fully paid members, hang on just a second. Freebies, there's something seriously wrong with you. I suggest psychiatric help. If you're not a fully paid up member, then what the hell is going on? You can't go through these times of crisis without getting good advice.